Well, it was rather decent performance coming in from Go Fashion in Q4. The company saw good revenue growth and gross margins as well expanded, though EBITDA margins, well, they contracted a little bit due to higher employee and other expenditure. We have Mr. Gautam Saraogi, the Executive Director and CEO at Go Fashion, who joins us on the show. Hi, Gautam. Good morning. Thanks so much for joining in. Well, towards the end of Q3 as well as the starting of Q4, there was this feeling that there was a bit of a pullback in terms of demand. But your SSG number of around 17% growth is not reflecting that. Tell us, how is demand shaping up and what kind of an SSG number do you want to guide for the first quarter as well as for the year FY24?
Yeah, hi, thanks. Good morning. See, I think by the end of Q3, there was a little bit of slowdown post-festive, and in Q4 also we felt the strain. I think this slowdown in the market is improving. What we've seen April onwards is that sales at the EBO outlets, at the LFS outlets have picked up. So I think by Q2, we should have normalized demand coming in. We are quite optimistic that sales would definitely come back to some sort of normalcy by Q2. As far as SSG growth of 17% is concerned, I think it has been grown by good volume growth. So we've had about 5 to 6 volume growth, which has contributed to 17%. So moving forward, we feel that a 10% SSSG number starting Q1 we'll be able to maintain.
All right. Gautam, hi, good morning. So, the absolute volume for the fourth quarter, which you've disclosed, is 2.38 million versus 2.35 million. Same quarter last year. We've got the full year numbers as well. So this is a little muted, right? Q4 23 over Q4 22. How should we square this off with the SSG growth, which is, of course, very strong?
See, actually, the overall volume has been muted because the dispatches to the trade channel were a little less because of some operational issues, which is a one-off item this particular quarter. It has already started normalizing from April onwards. That is why EBO looks stronger in Q4 and the SSG is at 5% for EBO. But the overall volume looks muted because of the lower dispatch to the LFS and trade channels because of some operational issues.
Okay, that's large format stores, right?
Yes,
I think you're in a very, the largest is Reliance for you there. You're expecting 20% sales growth in FY24?
No, in FY24, we are looking at a same store sales growth of about 10%.
Sorry, I'm talking about sales growth, top line growth.
Sales growth. Yeah, top line, we're looking at a 20% plus sales growth, and we are going to be adding about 120 to 130 EBOs in this year.
Okay, so 20% sales growth in FY24, and the same store growth, the same store sales growth will be 10% for FY24. Got that.
Correct.
The issue really, that we're talking about on the operational front is that this time your employee expenses have gone up considerably, almost a 40% uptick there. Your other expenses have gone up. I understand that, you're expanding as well. You're looking to increase the number of EBOs. But that is coming at the cost of margins. So do you think that this is the way forward? I mean, are you going to sort of sacrifice margins a bit as expansion moves through? And if yes, what would the margins be for the full year?
See, actually, I think what has happened is in our other expense line item, we've had a LFS receivable write-off in Q4 to the tune of about 4.75 crores. And that has really impacted our margins. So if I had to reverse that one-off receivable write-off, then our margins are pretty much intact. From an employee expense perspective, yes, we are adding EBO stores, we are adding LFS. So the employee costs, all these are front-end employee costs. So that is obviously higher because we are adding so many stores. But the other expenses, which has actually really hit the EBITDA margins, is because of the one-off LFS receivable write-off which we have taken.
Sure. No, I got that. So, X of that one-off, what do you think the blended margins would look like in FY24? Because you had done about 33-34% margins as well. This was way back in FY20. But now going ahead, what could the margin look like?
At an gross margin level, we would be looking at a 60 to 61% gross margin. At EBITDA level, it would be about 31 to 32% EBITDA, steady state. And at a PAT level, it will be about 13 to 14% of PAT.
All right. Okay. You've got those numbers crystal clear. Then let's focus a little bit on the working capital cycle. Now, inventory days came down, which was good news. Your working capital days, I think, have reduced from around 190 to around 149. Can you better this? And what is the number we should be looking at from here on?
So rightly you pointed, our working capital days has come down to about 150 days now. And in this coming financial FY24, we are looking to bring that down to about 120 days. The way we are going to bring it down to 120 days is actually bringing our inventory days down. See, currently our inventory days is about 121, 122 days. We are ideally going to bring it down by about to about 95 to 100 days. So by that, we'll be able to reduce 20 to 30 days in the working capital front. So our overall working capital days could fall from 150 days to 120 days.
All right. Very quickly, the promoter holding, I think there's a small pledge out there, 16% pledge. Why is that? Any plans of reducing that?
This we are taking for personal reasons, and we are looking to clear it by end of FY24.
Okay, that's great. So you will clear your entire pledges by FY24 end, is it?
Yes, correct.
All right. Thanks a lot for joining in. That is very helpful. A lot of numbers shared with us, and you sound very optimistic. So all the best for the future. That's Go Fashions doing pretty well. They're talking about a 10% same-store sales growth in FY24, 20% overall sales growth, and margins will pick up as well.